Amy Wu Silverman, head of derivatives strategy at RBC Capital Markets, joins us now. I was talking about you're going to go across the universe in terms of markets that you're watching right now. All right, it's January. We're setting up. What are options or derivatives telling us about the tail? What is the tail telling us about the dog?
So look, we just put out our 2026 volatility outlook, 4 main predictions, but the gist of it is that it's going to look similar to last year, but it's going to rhyme. And one of the key things we discuss is you've seen a lot of this exuberance in call options, the YOLO, FOMO, and the AI side. One of our predictions is that you're actually going to see this mechanism, but in an industry you wouldn't expect, so perhaps like healthcare. And a lot of that has to do with this retail leg of the stool we've talked about, where people are waiting for this leg of the stool to be taken out. I don't think that's what happens, Joe. I think you're actually just going to perhaps see a move on because there's so many other things that you can use to express optionality with the prediction markets, cryptocurrency. So it's possible that retail could just move to something shinier, but not necessarily something scarier.
And there's plenty of new things, new shiny things that you just mentioned. And you mentioned, I guess, crypto's one. Obviously, prediction markets is another. Short-term options, they all go into this. So some interest comes away from traditional retail buying and just equities and goes into these things. So equities come down, but not for any horrific reason. Is that what you're saying?
No, I think, look, it's probably still going to be a relatively strong year for the market. I think a lot of people have been asking, if you take away the sustained retail buy the dip, does that scare the market? I think actually what happens is if you lose that support, again, it could be to something different like zero-day options, changing your tenor or changing how you express things. Just think about what occurred with Venezuela. You're actually seeing people play that in the prediction markets itself. 10 years ago, there was really only one venue, which was the option markets. And so you do see some sort of disintermediation. And what that has created, the one thing I think is really interesting to think about is there is this shadow hedging complex, which we talked about last time, which is this idea that there are people who are interested in hedging, but because you have these April 2nd situations where the whiplash is so high on the right tail back up, there's a lot of reluctance until we see downside momentum confirmation.
Why? You don't really usually dabble in fundamentals. These are not all exactly the same. YOLO, FOMO, and MOMO, but they're all kind of the same. So you only live once. You fear of missing out.
MOMO?
MOMO's momentum.
Momentum.
Yeah. Why would you say it could move in the options craze away from AI to healthcare? So you're picking why healthcare? Are you seeing technical signs of that, or you think there's a reason for it?
So one thing we see that's an indicator is this idea of option skew, which simple definition is just the demand imbalance between put options and call options. Usually, and this has been true for 30 years, the put option demand is higher than the call option demand because most folks are long and they're trying to hedge.
Right.
And what happened post-COVID is this totally flipped on its head. We had to take the playbook from 30 years, throw it out the window, and a lot of that had to do with retail, which really prefers to buy call options. You're starting to see signs of that in kind of not boring industries, but industries that you typically wouldn't expect. So we've seen it in AI already. We saw it in your meme stocks. But we're starting to see it shift into other industries. The reason is people are looking for a show me for AI. They're saying, great, AI is wonderful. There's all this CapEx expenditure, but what is it going to help? Is it going to help make the healthcare industry more efficient, industrial? So when you're starting to see these show me ideas bubble up, to some degree, it is an extension of the AI story, but the technical indicators, I think, will start to map into industries that you haven't seen in the last few years.
So if you're not using puts because you're already long, then it's skewing the calls, then it's FOMO. Then you're not in, and you're trying to cover yourself by having calls. So is that bullish? So overall?
You know what I would say? I call it the reluctant rally in the sense that if you're a portfolio manager on day one and you've been living through this market the last 3 years, you know how heavily concentrated the market is in certain things. And just because you have to participate, because you have to meet a certain benchmark return, does that mean you're bullish? I don't know, but it still means you have to participate. And we capture that
sounds like the opposite
factor
of what he's talking about, though.
But it doesn't mean that you're not in the market.
I'm in the market, but I'm afraid.
But I'm reluctantly in the market. And that's why I call it shadow hedging, meaning a lot of these folks actually do want to hedge. They do feel rather bearish, but they're afraid to because what happened April 2nd?
Right.
You got that sharp sell-off, but you got that whipsaw back up. They spent most of that year chasing the right tail, not protecting their left tail. And so it's, again, the same mechanism of every investor I have these macro roundtable dinners with, they tell me they're pretty bearish. And then I say, well, are you in the market? Absolutely. I have to be. And so I think this continues. And then you even see that chase more to industries that you wouldn't expect.
You know, you never catch your tail if you chase it. And
my cat does.
Yeah, my new German Shepherd
my cat can catch his tail.
He just saw his tail. He's 7 months old, and he just saw it. It's like, wow. And it keeps...
Pretty exciting.
It's like, I was going to go on to something else here. So you think, okay, again, you're mostly technical. Taiwan and Greenland loom large in your mind at this point.
It does. And I will tell you, when the Venezuela news initially came out, when the Venezuela news initially came out, the first 3 pings I got were about Taiwan, about the Taiwan tail, because obviously this is essentially a precedent for other of these situations happening. I mean, and it's not like the PRC hasn't discussed it. It's not like Trump hasn't discussed Greenland. I will tell you, we go to these volatility conferences, and every year the Taiwan tail is thrown out as something that could possibly happen, but has never felt more real to clients.
Yeah, it feels like a fatter and fatter tail.
It's a much fatter tail this year. People are much more explicitly asking, how do I express this?
So you don't believe John Thune?
I mean, you know what I would say is there are so many things that have happened that you could use the word unprecedented in front of it, Andrew, that we've had to then
So you should raise these questions.
I think so. I mean, I think your Overton window of what is possible in this administration is just larger. And so when you think back to what other countries have said, if we go to these spheres,
I've been told I shouldn't ask these questions every day.
Well, I'm not saying
because these questions somehow are inappropriate.
That's
because we every day listen to these things, and we've become so inured to it that I'm supposed to just
whether or not we ask it or not, I can tell you the market is asking it of us.
They are.
So it's
I heard about that.
That's why we talk about it. I'm not telling you not to ask it. I'm just telling you that the worst case scenario probably isn't going to happen normally.
And that's always a matter of perspective, in the sense of it might be a worst case scenario for some and not others. And that's a market question in terms of...
Oh, it's a perception question,
of
too.
Of course.
I mean, and political. I mean, there was a candlelight vigil about a 5-year anniversary yesterday of January 6th. And so once I look at that, and I think it looked silly. I think it was ridiculous. On the other side is like it looked like a pall was cast upon me.
And so, Joe, that's what makes a market.
That's what makes a debate, and that's what makes a morning TV show. And
I can tell you that the tails are fatter wherever you stand.
But you can't. If they're fatter, you ought to be able to catch them because they're moving slower.
And the thing I would say is, what I thought was really interesting about the way the Venezuela situation worked is it went straight back to AI. In the sense that, think about what was first on clients' minds. They saw this kind of geopolitical event happen, obviously impacted energy, but what do they think of next?
Taiwan, and they worry about the chips.
Of the
chips,
happens, right? So all roads come back to AI. What I thought was so interesting about the calls I received is what's still on investors' minds, no matter what happens geopolitically, you go back to the chips.
Did we glean anything that the market's up 1,200 points after the invasion of Venezuela?
I think geopolitically, this has always been difficult for markets to price, especially as we go more short.
But you know what I'm saying? Or tariffs, as of living. Did the worst case scenario of tariffs and hair on fire moments for 2 months on tariffs, how did that play out for people that thought tariffs were going to...
So volatility's remained quite muted on that, and there's been a lot of dispersion.
We're at new highs, and pointing out that, that panicans usually don't make money in the markets. There's nothing wrong with doing that.
And if you look to April 2nd, even when you do have the panic, you again have that right tail back up to worry about.
You do. And that was a much bigger worry than the left tail on Liberation Day, was it not?
Yes. And one other thing I would say is, when going back to what is the appropriate hedge, one of our other predictions is, when you look at what has been used to hedge that's actually worked, it's typically been gold and not as much your VIX and S&P complex. That's another change that's happened because of the dispersion we've seen in the market.